Welcome, everybody. We're going to let folks start trickling in right now, and we'll get started in about a minute or two. Okay, great. I'm going to go ahead and get started. Welcome, everybody. I know you're continuing to come join the call. We can see the numbers rising. I'm J.Thelander, and we are pleased to have one of our great private company compensation panel and webinar. I'm going to go ahead and share my screen. Let's see. And then I will turn it over to my esteemed panelists. Christy, I'll let you go ahead and introduce yourself from Hatteras Ventures, and of course, Mark Fitzgerald from Wilson Sonsini, and then we'll move right into our program. Christy, great to have you.
Thank you, Jody. I'm excited to be able to participate in this compensation panel today. It's so important. My name is Christy Schaefer. I'm a partner with Hatteras Venture Partners based in North Carolina. We've invested in over 90 companies now across 7 funds. I, however, did not join until the 4th fund because I was CEO of a company here in North Carolina that I was able to join at the beginning and take it public. And I've served on now over 12 corporate boards, mostly on the comp committees, and have chaired comp committees. And I also serve on 6 nonprofit boards, including a large nonprofit research institute. So as Jody would say, I have the ability to sort of see this from all different angles.
Great, that's great. And Christy and I did a panel together from Launch Bio in North Carolina as well, which is great. So, all right, and Mark, you know, we've been doing this a long time, as we said, partner at Wilson Sonsini, all of areas of expertise on the, you know, change of control, severance, employment agreements. Mark, fill us in on what's going on in your practice in Wilson.
Hi, everyone. Mark Fitzgerald. I'm a corporate securities partner at Wilson Sonsini Goodrich Rosati. Been with the firm since we opened our first East Coast office back about almost 25 years ago now. I'm head of the Boston office of the firm, and I work with, we have about 4,000 private company clients, I think, at this point. And I work primarily in life sciences and technology sectors, but kind of all outside general counsel to a lot of these firms.
Great. Well, the reason that we're all here is that it's obvious, as you can see, we cover all aspects of what the private companies are doing, and we all have a different perspective that obviously works together nicely with our data. So with that being said, I'm going to jump right in. And we would like today to be, we did get some questions ahead of time, so we've reviewed those, and we certainly will rely on those. Also, if you want to put questions or comments, things that you'd like us to spend more time on or have something specific, please go ahead and put that in the chat. That is being monitored, and I've got someone Morgan is going to be sending that to me as well, so that we can keep up with what you'd like to know more about. So without further ado, by way of background, I've started J.Thelander, private company compensation surveys and the whole business 26 years ago. And we also have Morgan as the COO, my number 2 and daughter, which is nice. We've got a legacy firm. Morgan's been here for 6 years. With her help, we've now moved the platform onto our own, IT and IP, and also we are updating our information almost every day now. So it's very real time. I think that's the nicest thing that's come over. The survey information is running all the time, and we are covering private company compensation, salary increase and bonuses, merger and acquisition, change of control and severance, and non-investor sort of outside board member compensation. And so we have over 3,000 companies, not quite up to the Wilson Sonsini level, but still a nice number, that are updating and providing information, and that's all real time. The jobs that we're covering, this came up in some of the questions as well, go all the way from the chief jobs, VPs, directors, down to all of the engineering positions, the science, clinical, research. I mean, there's so much crossover now, research and folks used to just be for life science companies. Now they're also working with artificial intelligence and robotics, which can very easily be a tech company. In addition to that, all the HR, marketing, administrative operations, really every job imaginable. And it's great because we have the mix only of private companies to see the cash and equity. So there's no public company data in here. Industry-wise, we are about half in the life sciences space, but again, there's quite a bit of crossover with these jobs. And then tech covers all the usual suspects. And we do in our survey have the ability to slice and dice. And people in the survey tell us the different areas that they're in tech. And then on the platform, you can also go ahead and customize those to see. But really, I don't know, Christy, I know you've been on so many boards. I mean, the industry is, great for certain roles, but there's quite a bit of crossover.
Absolutely. We cover medical devices, biopharma, biotech, as well as diagnostics, and more recently, healthcare IT.
Right, that's exactly it. Yeah, the healthcare IT. We see it here at J.Thelander, and Mark, of course, always like to hear your thoughts on this as well, that the best way to look at comp data, really the single point of truth in addition to industry, is by the total amount of financing raised. Valuations have been very choppy over the past few years, and also with the private market staying private longer, you can see that 200 million plus. We used to just go to 90 to 190 million plus, and now it's 200 million plus. So from your vantage point as corporate counsel and outside counsel to companies, how are you seeing this play out in terms of compensation and looking at option pool information with your clients?
Yeah, it's interesting, and it's a good way to look at this is by financing amount raised. I think in the past, people have put too much of emphasis on labels, like is this a Series C round, or is this a Series A round or a Series B round? And a Series A round in life sciences, for example, is something quite different than a Series A round for a tech company. But even that, with the changes in valuations these days and how deals are happening, I'm doing a round right now that's a Series Seed round because people thought, well, that's about the right amount raised, but it's actually a Series A round because the financing amounts in this funding environment are just different. But one thing that is pretty consistent is having an equity pool reserved for future hires that is consistent with expectations for how long the current money will last, and usually you're looking at like a pool for about 18 months of equity that you need to kind of budget for.
Yeah, we're going to get into the equity pool information. We've had a lot of questions came in around what is happening with the cash equity mix, what's happening with different geographic locations, what's happening given the current amount of, the funding climate, given the fact that there has been somewhat of a down market right now. So I'm going to get into some of that comp data. The primary location of companies, about 90% of the companies that we survey are in the United States, domestic. And then as you can imagine, within the United States, we cover the country. And everyone reports the comp information to us in US dollars. And we can tell, obviously, if someone's in a third world country where the minimum numbers are extremely low, obviously all of that get dropped from our data. So our minimum and maximum numbers are not outliers. They're numbers that have been scrubbed and there's data hovering. So they're true numbers. On the executive comp side, let's see. We also had a question come in saying, this is a long one. I wonder if you're seeing pay cuts at the VP level above in the private sector. What does this typically look like? Meaning what percentages of cuts are you seeing? Okay, let's get into we're going to start slow here. Let's start with the basics. What are the different levers of compensation? So we look at cash compensation, which can include, always includes base salary. And then it can include a bonus. So what we survey are current bonuses, which means it's an actual bonus that was paid. And then a target bonus, which is a bonus that is projected out on typically for a year. And that gets you to total cash. So total cash can be a combination of base and a bonus, or it can just be base pay. The next lever, which is very important, obviously, is sort of the whole reason why private companies are private and the value and the wealth creation and the whole trajectory and why people like Christy and Hatteras are investing is the equity component. And so we have founder shares. Again, Mark, I'm going to speak for you and you can correct me, but the founder shares are what are given to what are people who typically found the company, but there is no one definition of a founder, right?
Yeah, that's right. And when people hear the term founders shares, they think, oh, well, that's a special type of stock, but it's usually just common stock that's initially issued to the original people who formed the company, and it's usually at a pretty low price point.
Exactly. And then we go from there to have founder shares for current job, which means they got those first founder shares, and then they have continued on in their CEO role. Like Christy, you know this from your own experience, or you go into your CTO or chief medical officer, and that equity has been diluted. And typically, you want to make sure that you're keeping to market. And so founders get additional equity for their current job. And that is different than a non-founder, somebody who comes in from the outside after the company's been founded, and they have what's called non-founder shares. And here are some amounts for us to take a look at. I know we have a mix of biotech, medical device, tech people here. So we have a sampling of data, but this will start our discussion around. So this is for a CEO of a biotech company that's raised under $15 million in financing. And you can see here, we showed you median, 75th, and max. And that really is where we are seeing the market use percentiles differently. So we have minimum and 25th, but it always comes up that people want to see the max numbers, because those numbers, as you can see, represent a very robust number. And it's a very steady group that are at that, especially if it's a seasoned CEO and someone who's had success in a previous biotech company. But you can see base pay, bonus is an actual bonus, and then the total cash. So the sample size for this is 100, but I know for certain that the not 100 people had a bonus, which is why the median numbers are not a straight addition, or any of the numbers for that matter. And then this is the total cash, and then founder equity, and then non-founder equity. And we had a question come up, and Christy, I'd be interested to hear your thoughts on this, and Mark as well, is basically, can you put in place a clause that if somebody isn't getting, or if you know that someone has to take a cut, right, they can't be paid up to the median number for their total cash. And they know, so let's say everyone's making $100,000 and their equity is competitive, but not extreme, right? Maybe it's at that 10%. Can you put something in place that says when we raise our next round of financing, we're going to correct this to market? Or I don't know, Christy, from your board experience, or Mark from your legalese, how do you do that successfully, and what is reasonable?
Well, I think it's a great question. And I would say that what I've seen is more verbal agreements as opposed to in writing. And that's why I'd be curious to hear what Mark would say, because a lot of things can change during that period of time while you're trying to raise money. And maybe you're not successful raising as much money as you thought. So if we had a good CEO that we knew was being a little bit underpaid, perhaps we're making it up in equity. Or one of the things I like to do is sort of, juice up their bonus if that raise does occur. So if there's a successful raise, they get an extra bonus, and then, kind of a verbal agreement that we would look at everybody's pay and potentially increase theirs, getting toward what would be more the median, as you said.
Right. So Mark, what's your thought on that?
Yeah. And I agree. I would use a little bit different language because usually it's not an agreement, verbal or written or otherwise. In these funding environments, a lot of what we're seeing, some companies are doing down rounds, some companies are taking longer to raise money, and
yes,
whatever the operating budget was, the boards are revisiting that. And so what ends up happening is people take a pay cut, usually kind of founders, VP and above. It's usually the kind of higher level people, and frankly some lower level people are let go just to kind of make the operating budget. And then the expectation, and I say expectation rather than agreement, is right, that if there's a funding raise and people kind of stick with it, that they'll be made whole or better, depending on how the financing goes.
Right. Well, that's what came up, actually, a couple of questions here. So first of all, just to clarify, this is total amount of equity, not an annual. This is the numbers that we show are what are the total equity percentages. And the best way to look at this is by the total amount of financing, because as you can see, here's the next category, right, in the 15 to 50. So you can see total cash has gone up and there has been dilution. And a question came in, is it common to see an anti-dilution clause? And I already know the answer to that is no. And if you have one, it likely won't even hold. Christy, go ahead.
Yeah, no, those
No.
just aren't usually.
They don't hold. Yeah. Mark, you.
Yeah, I'll say, that you don't see those generally, and this also comes in line with expectation, right? As companies progress and roles change and people either get promoted or maybe take, a lesser role and aren't contributing as much, the equity kind of gets right sized along the way. And that's where we call, I think we'll probably talk a little bit later about refresh options and things that after a financing, where if the percentages are out of whack, then the board will look at with management's input, the board will look at it and say, yeah, this person should probably be, plussed up a bit. But
I mean, that's the essence of our consulting business, but I can't implore you enough, no matter the earlier you use data and analysis, ideally J.Thelander, since this is, our whole wheelhouse and why we have the platform, the sooner you understand the market, the better off you'll be. What you decide to do with it is up to you. And that way there is no surprise moment where you've gotten diluted and your equity percentages are too low. And you've been very genuine, especially life science folks, to really believe that the board will take care of you. And it's better to just know and be armed with the right information, decide where you want to be on it. You want to be playing to the 25th, the 50th, the 75th, the max. What's the philosophy with cash and equity? Because that will mitigate as many problems as possible. And my feeling is from seeing this on the consulting side, the sooner you put that infrastructure in place and you choose your narrative around your comp philosophy and know where you want to be, and you understand how you're going to scale, the better off you'll be. I mean, Christy, I hear you. I can see you already have an opinion on this, and obviously you've experienced this from all sides.
Yes, and I do. I'm a big fan of having a compensation committee formed as early as feasible. It's hard if you only have a 5-person board, but right. I think it establishes exactly what you said, Jody, which is the philosophy of what you're trying to do. The first thing I like to let people know early on if they're in the first startup is to say dilution is inevitable, right? You need to understand that. How we deal with it is a different question. So understanding expectations sooner rather than later, as opposed to when there's a crisis.
It's a bad position to be in to slide down. Yeah. I mean, here you can see, for example, for a biotech CEO, let's say you're coming from the outside, right? The median at 4.85 and the 75th percentile at 5.57. And I guarantee you the 25th percentile is probably around 4%. It's a very stable market. And people have asked these questions consistently and are, ahead of time. What's being affected right now because of the current climate? And what's being affected is the different use of the percentiles, because, as we discussed earlier, as we were prepping, it's taking longer to raise money. And good companies are raising money, but they have to have runway for a little bit longer. So, Mark, do you want to give us some commentary on that? I mean, you were discussing this as well, that having an 18-month option pool.
Yeah, and that 18-month comes from really how long a financing round is expected to take you. So if you get around in this environment, sometimes there's kind of patchwork rounds where it's like, okay, we can't raise everything we expect, but let's try to get us 12 months down the road or 9 months down the road with a smaller amount. And then the pool should kind of reflect what equity do you expect to grant over the next 9 months until the next round?
Right. So I pulled up. I mean, it seems like we're here. So I went down for a second, so we don't have whiplash from looking at the slides. But let's talk about the option pool information right here. So this is from our salary increase and option pool data, and here is percentages of ownership. And this is for an early stage company that we consider to be $5 to $15 million in financing raise, or 14.9. And you can see the founder's equity is relatively high. Depends the founder's equity is higher given how, we don't know how many depending on how many founders you have. And then you can see the investors are slightly lower here. And then the employee pool, though, running in that 10 to 15%. This is for outside board members. So you get into the next stage of fully diluted shares for the option pool and that 15 to 50 million of financing. This employee option pool is staying very stable. Again, that 15% or so is a good number to follow. Christy, would you agree with that?
Yes.
Yeah. And then the founder shares have gotten diluted. No matter how many founders there is dilution to the founder's equity, and the investors are going up. And this goes all the way through. Here's the late stage company, right? Employee pool staying very consistent. The founders are really low down on their founders shares. This is why they need additional equity. And then the investors are up at a very consistent, right? This is the 25th, 50th, and 75th percentile. So I hope that answers. And here is, Mark, if you could talk us through this slide, because this is really what you were referencing.
Yeah, so the number on the left is what's reserved for the future option plan. So that's basically what I was referring. You have to have enough unissued and reserved equity in your pool to kind of get you to for the predicted hires for the next round. I will say, I think there was a question about, is it just the investors coming in that dilute you as a founder? Whenever there's a round, there's usually, because you want to have enough future equity for hires, during the time that money is deployed. Usually there's an increase to the equity pool kind of at each financing, the unissued equity pool, to make sure you have enough. And that, and this is just a matter of kind of what's market, that comes out of what's called the pre-money capitalization. So effectively, anytime there's a new round, new investor comes in, Series B, Series C round, there's going to be an increase to the pool, but that increase happens at the pre-money stage. So right before the investors put their money in. So it's really just diluting the founders and not the new investors. That's pretty common.
Right. And that's where obviously knowing where the founder total equity should be, because if the founder had a lot of founder shares, they may not get additional equity for their current role. It's a total number, right? And I'm going to say this slowly because it's very important. This comes up all the time. If a founder was at that high level, let's say 70% of the company, right? And then you raise capital and they're diluted down to half, they still have a lot of equity. If the founder started at 10% and got diluted down, then they are quicker to need additional equity past their founder shares. So it's not a one size fits all. And then a question came in, Mark, and I think this goes to you, is do founders typically give some of their equity back to go into the option pool, or is that just through, it really depends, right, on how much they got to begin with?
Yeah, it's usually basically just there's a number of shares and you issue more shares, and that's kind of where the dilution goes. Usually you don't give shares back to the pool unless there's repurchased by the company and you're getting some type of partial liquidity, but
Right.
it's done by an investor coming in and buying some of that
Right.
stock.
Great, thank you. So this is a question, and I know that, Christy, you have an opinion on this, and a question came in on this as well, is do you have an evergreen program to grant follow-on refresh options to employees? And our data says squarely, we have a program and we do it, but it's a formal program. So from your experience, Christy, being on boards and comp committees, I would assume that you don't like the word refresh or evergreen, that it needs to be handled on a case-by-case basis as needed.
Absolutely.
Yeah, and after financing, and much of this again is predicated on where was your starting point? Did you do a good job to begin with, right? Because the as needed means, was somebody being given equity to market? Were they low to market? Are they high to market? So with dilution, are they now under, or are they still high? All of this is really based on the fact of getting the information right to, from the start. I'm going to move back to some comp data right now. I'm going to stop sharing for a second and go back up to, and also if we had questions on the outside board member, I'm going to go to that first actually, because people are asking questions on that. People are talking about board member, basically this is the independent board member compensation. Okay, share screen, here we go. Okay, screen's back up. So question came up about, are you, the board number, outside board member numbers were staying pretty flat for the different total amount of financing categories. And that's because the outside board member compensation does stay pretty consistent. I mean, Christy, how do you see this when you're working with outside board members and you bring them in? We are seeing that they can be paid by a mix of either one-time equity, annual equity, and then one-time cash or annual cash.
Yeah, well, first of all, let me put a big plug in for having an independent board director on your board that is a content expert. I think they're really valuable, incredibly helpful to the CEOs, particularly if you're first-time CEO. Now, I see a mix all the time in terms of public company boards, which I serve on, but on private companies, I would say it is usual more equity than cash, mostly because they're cash constrained, but you can do it, obviously.
Yeah, it happens more with life science companies where you have somebody maybe who's in the medical field and they're used to getting paid when they're leaving the hospital, or that's a mindset. But basically the levers are a mix for biotech of either one-time equity or annual cash and one-time equity. And it depends. This is where you use the levers in correlation to each other, right? They're interrelated in that if you go higher on equity, right, the 75th percentile for one-time equity at 1%, and also for if it's mixed with cash, is generally for someone who obviously is a very name brand, someone who has a lot of cachet, like what you're saying, Christine, is really adding credibility, so they typically require more. I mean, Mark, what are you seeing with your companies on this?
Yeah, and definitely a difference in life sciences, and in particular, if you have an independent who's had a nice big life exit from a life sciences company,
right?
A lot of them, the cash is meaningless to them because they've already got enough in the bank, and they're more concerned with the equity. But as you say, on the life sciences side, if somebody's providing, if you've got somebody who's, either at a hospital or might help with a clinical program, they may be more cash focused.
Right. And a question came in. So for vesting schedules, hang on, I'm going to move with this first. So here's tech companies. Not many people are getting annual cash, generally getting the annual equity. And I'm going to stop sharing for a second because we had questions and I'm going to pull this up. Here we go. I love that we have this information. I love when people ask questions and we're like, yeah, you're not the first one, because that's why we have this information, because someone asked it and we went and got the data. So vesting schedules in general for everybody, and we have not seen this change at all, are 4-year vesting with a 1-year cliff. And it's the same for the non-investor board members. Christy, thoughts, opinion on this?
I would say that's what occurs 90% of the time. There have been exceptional situations where someone is reaching retirement age and really only wanted to do a 2-year term, essentially, or agree to 2 years, and we allow that to vest over 2 years. But most of the time, it's exactly as you've said.
Yeah, Mark, is that what you see too? Yep.
Yeah, and I'd agree. And I'd say one. I don't think it's in here, but with employees, you usually see a 1-year cliff followed by.
I'm going to pull that up.
With non-investor board members, I usually don't see a cliff because it's, they're kind of coming on board and they may last on the period or not. So it's usually just monthly.
Yeah, you have so many questions. Yeah, go ahead, Christy.
Well, I was going to say, I agree with that. A lot of times, I'd say it's 50-50. What I've seen is a lot of times there's no 1-year cliff, and it really depends on if there's a real conversation actually about somebody joining the board. A lot of it is around, they're just very interested in the company, and so they don't quibble over it. But occasionally you have somebody that feels really strongly about not having a 1-year cliff, which of course, usually you'll say that's fine.
Yeah, we have a lot of great questions, and I see them coming in, and trust me, I'm moving as fast as I can here. I don't want to move so fast that we can't, do this in a cohesive way so it's making sense to everybody. But I'm going to move into now the equity grants. Here's the type of awards you currently grant. And Mark, I love when you help me with this one because there is some legalese around this.
Sure, and I'll start by saying the two on the right, we don't see as much, and it's obviously
Right.
You can see that it's reflected in the percentages. Incentive stock options and non-qualified stock options, those relate to tax benefits for service providers, and incentive stock options are typically go to employees. They are incentive stock options because they meet certain requirements under the Internal Revenue Code. Basically, it has to be to an employee. It can't be exercisable more than 90 days after termination of services, and you have to hold for a year after you exercise to maintain this incentive benefit. And the benefit is that at time of grant, there's no tax consequence. At time of exercise, there's also no tax consequence. And then when you ultimately sell the underlying stock, it's all capital gains. So there's no ordinary income issue. Anything that doesn't meet the requirements of an incentive stock option is non-qualified. Typically no issue at grant. There is a tax implication at exercise. The delta between the fair market value and the exercise price is comp, and then anything after you hold is capital gains. So there are a lot of nuances to that, but that's the alternative minimum tax and things like that. But that's generally how those work.
Yeah, I mean, that's a whole tricky area. We oftentimes have Christine Leon Connors, who is the president of Epic Capital and spent a previous lifetime at JP Morgan, and she wasn't able to join us today. And we don't really find anybody who does it as well as she does. So we just decided...
I will, and since she's not here, I'll just say the one really important point that she points out that I talk about as well is incentive stock options, because you have to hold them a year after you exercise. Most exits are M&A exits, and so in most M&A exits, you just get kind of the delta between exercise price and the price per share in the deal. That will all be ordinary income if you haven't early exercised your options. So there's a process called early exercising where you can start the clock on the whole.
And she always says it's not a now or never, like you can do that along the way. So in terms of equity grants, here we're talking about, the different types that you have by financing. So again, you're seeing incentive stock is the most prevalent. And here's the vesting questions. And do you provide vesting in the equity awards? And the vesting is typically 4 years. And then how long is vesting? 4 years. And then it is time-based vesting, and you require 1 year service prior to vesting in any new shares. For new hires is yes, that's typically the 1 year cliff. No post-termination exercise. So that is what you're talking about, the 90 days. And also here's the post-termination, extended post-termination exercise can be that top 10 to 12 months. We're probably not seeing that as much anymore. And then also we do ask if there are in the refresh grants, do you also have the 4 year vesting in the 1 year cliff? And we do see that is common. Christy, what are you seeing with your portfolio companies?
I would say that's fairly common.
Yeah, I'm going to pull that up on the refresh. Okay, and then everybody wants us to go back to the comp information, which I'm going to do, but there is, I want to grab this information just so we can see. Question came up also about the accelerated vesting. So I'm going to move to that real quick. And then I know we have questions on geographic location and other unique, I see these questions and we definitely will address them. So accelerated vesting in connection with the change of control. Again, this is making sure that you have your equity right? Because it happens. so whether it's single trigger or double trigger, I just wanted to look at one of the questions came up about this. It also, like, people keep asking, Mark, is how much of this can be put into an employment agreement? How much of this can be arranged ahead of time, especially if somebody is taking a haircut on their compensation or their equity, knowing that they're doing that? Is that ever put formally into an employment agreement? So those are great questions.
Yeah, accelerated vesting is typically part of an employment agreement for like a CEO or CX, anybody who might have an employment agreement. And it's only a few people at the company who actually have employment agreements.
Right.
Usually you don't. But accelerated vesting of options under the option plan, typically the plan itself will provide the board the option to accelerate vesting for everybody in the event
Right.
of an event.
And it's usually 100% acceleration, right?
But for under the option plan, it kind of depends on how a buyer, what you want to have in place that will incentivize a buyer. But as far as the CEO acceleration, yeah, it's complicated. 100% in a eventually, but there's the single trigger. You mentioned single trigger and double trigger.
Right. Here we go. Everyone is surprised that it's single trigger, and the double trigger is 45%, but this has stayed consistent throughout the years. So tell us what this means. I know it's written here that it's change of control alone enough is for the acceleration, or it has to be followed by a termination as the double trigger. Yeah.
And conceptually, I mean, it makes some sense, right? If you've got somebody who's important to the company, if there's a buyer who comes in, the buyer will want that person to stay with the company, if nothing else, for transition purposes. And that's usually a year. That's double trigger. So double trigger would mean you have to wait until not only the M&A event, but you have to stick with the buyer and help with the transition in order for the rest of it to accelerate. Single trigger means it all happens at the acceleration. There's not as much incentive to stick around afterwards unless you're getting something else from the buyer.
It depends. And we do have those. I was looking to see, that's why I was flipping through the slides, because we do ask all those questions. And we do have in-depth information. It also comes into, we had a question somewhat about sort of a carve-out program. So if you get to this, but the people are underwater, right? And Christy, I'm sure you've experienced this, then you carve out a percentage of the deal proceeds to incentivize people to stay. And that is typically done in accordance with what their equity should have been in the first place, right? I guess, Christy, that's my question to you.
Well, it certainly can be, but it depends on what's happened with the company. It's very company specific. So it might not be possible it might take all of the proceeds to do that because the company's really underwater. So you try to do what's fair is the best way to describe it. Mark, what would you say on that front?
Yeah, and I'll just for the audience to understand it a little better, a management carve-out plan. I typically see it happen when you've got enough preferred stock rounds where the liquidation preference has kind of stacked itself up.
Yeah.
That if you were to sell the company for what you might expect to sell the company for, it might not clear the preferred stock liquidation preferences. So what a carve-out plan does is it says, we're going to carve out from the proceeds of any M&A deal above the liquidation preferences. We're going to have an obligation to pay some dollar amount. It's usually a percentage of the deal,
right?
Management, and the reason for that is to incentivize management to get the best value.
Right.
So that's the purpose of it. And I completely agree with Christy. It's very specific.
Case by case.
It depends on how big your liquidation preference stack is, how out of whack the management is, and how much you need to motivate management to kind of find a good buyer.
Right. So it's financial incentives generally, but it does go to the fact that getting the equity right in the beginning and understanding where you are with the liquidation preferences is very important, because you want to make sure that your house is in order, getting to some deal terms, because you don't want to find out at the end of the day that everyone else got off the top and there was nothing left for you in the end. we've had a couple of questions come in about, first of all, scientific advisory board, and we consider that to be the same as the outside board members. We don't distinguish. They're a category of outside board members. And so that information on the cash equity mix or whatever they get is the same information. And that's where the percentiles come into play, because depending on how scientific and, their expertise, then that's where you would use a higher percentile for them. And then the other question that's come in, and we're going to look at this right now, is geographic location. And we do not, let's see, I'm going to move into the tech data now. Okay, perfect. We do not see differences in geographic location consistently. Some jobs where there is a competitive landscape for that role, the geography makes a difference, but not as a straight across the board. People in the Bay Area make more than people in Boston, or people in Boston make more than people in Wisconsin, or people in Wisconsin make less than people in Texas. Christy, what's your experience with that?
Well, it's interesting because I would say 10 years ago, there was a difference. And, North Carolina, for example, at one point might have had lower salaries than the Bay Area. But as you've said, today it's totally different, in part because many people can work partly remotely, right? Yeah. So it just doesn't seem to matter. And also, there's such a desire to have top talent that you're going to pay people whatever these committee consultants are going to tell you. You're not going to nickel and dime somebody because you're in Wisconsin, for example. I mean, there can be a competition for talent in those locations as well. And again, I know I sound like a broken record, but that's where the percentiles come in, right? Mm-hmm. Because if you have somebody and there's not a lot of competition for that talent, then you can pay less and the equity can be less. If you have somebody who's a very special skill set, it doesn't matter where they're located, because if that person is a key role for your company, and you need to pay a certain level, and that's going to make sense for you because you don't want to lose that person, or the cost of it attracting them is higher, then you pay to the higher percentiles of the ranges. And sometimes you even go above that, but that's where the max numbers really show you that there's quite a bit of range. So this is the tech data for a CEO under $15 million. And this is the founder total equity and the total cash. Tends to be, we see tech companies generally a little lower on the cash side and higher on equity than life science companies. And then here's the factor again of the dilution, right? Now you're getting into the next category of $15 to $50 million of financing raised, and the cash has gone a little higher, the median 216, now at 256. And the equity for the founder has gone from 28% median down to 15%, and the non-founder equity has gone from 10% down to about 5%. So this is a natural course of events. There's no way to run from the dilution. The only thing to do is to re-up when you're raising capital, or when there's been some kind of change, or the option pool, you're hiring more people, or something's happened to cause dilution, and so you have to adjust, based on the market. Okay, I'm going to look here, and this is by experience. First-time CEO. I don't know, Chrissy, interesting to hear your thoughts on this. We see that a first-time CEO versus a second-time CEO, there's a premium for having more experience. Absolutely. I think the other exception may be that it's somebody that's had a ton of industry experience, may have come out of a larger company, and you really believe in that person. But mostly, as you said, the second-time CEO is going to make more. They also are going to negotiate harder, frankly, because they sort of know more about the compensation at that particular point in time. Yeah.
Mark, a question came in about, when is a comp committee put in place? Now, Christy, I know you would argue the sooner the better, but Mark, what are you seeing formally with this in terms of when are comp committees? Was there a certain inflection point that you see as outside counsel?
Yeah, I usually see it happen when I agree that it would be great to have them in place sooner rather than later, simply because, it's helpful even at the earliest stage for companies that have outside board members to have a compensation philosophy. Right. But I typically don't see it really happen until you have that kind of two institutional investors that are in the company. If you have like a round, and that may be the Series A round or maybe a Series B round, but sometimes you'll just have one institutional come in. It's not really a need for a comp committee at that point because they just kind of have their discussions. But when you have that second larger institutional investor in, I think that's where you kind of start seeing committees being formed.
And I would totally agree with that. I think what it does though is it makes you much more disciplined about looking at the compensation and really listening to management, because it is important to management. And if it's just thrown in at 5 minutes at the end of a board meeting for a discussion, it's not nearly as helpful.
What do you find the major role, Christy, as you're on a comp committee? What's the protocol that you come in with? What kinds of things are important as people are putting a comp committee in place to really pay attention to?
Well, I think you're looking at everything from what does the compensation look like right now if you haven't been involved before? In other words, is it fair? You want to know how many hires are you planning on, bringing on board? How expensive are they going to be? And really understand the plan over at least the next year, if not beyond, but to really get a feel for philosophically, how are we trying to recruit people and how are we going to be competitive? And it isn't just compensation. I do think, and I think I said this when I was on the other panel with you, Jody, is that having a positive corporate culture and having teams that want to work together are really important. So don't forget all of those things in addition to the money and the options. But I think the comp committee will just be more rigorous about helping the CEO, and especially if they're first time CEO, think through what should we be talking about for the future of the company right now and in the near future.
Yeah, and the more formal, the better, because, you also mentioned the role of an outside consultant. Obviously, we consult with companies all the time, and we feel very strongly, especially in the private markets, which is different than public, that our role is to tell you, here's the landscape, here are the different routes that you can take to get to your destination. But the ultimate decision about what's competitive is really up to you as the comp committee and the company. We're sort of here to guide you on what the terrain looks like, but not to give you the ultimate decision, because you know better, who is important, what are the key roles, and what's it going to take to get to the goals of your business. We've had some questions come in also. So this is life sciences versus tech. So this is where we're talking about not only geography, but in some cases, like roles like a VP of finance can go, obviously, they don't have to have a certain experience in terms of industry to be able to be successful in a job. And you can see that life science, they pays a little bit more, but the equity is about the same. The median is a touch higher, but the 75th percentile is the same. And a question came in versus, let's see, I'm going to move here. So a question came in about Europe versus the United States. And it really depends where in Europe. I mean, London's on fire right now. And as we know, there's some areas in the United States that are struggling. And so it really depends on where there's financing going on and where there is, deal flow. I don't know, Chris, you have a thought on that?
Most of our companies are in the U.S., so I'm not sure I'm the best one to answer that one. Maybe Mark has more views.
Yeah, I'd agree. London, and I mean the UK generally is
right.
It's hard to tell whether it's a temporary or kind of permanent phenomenon. But yeah, I'd say that is becoming more in line with the U.S. I think Europe, other jurisdictions, is a little bit all over the map because they also have different issues, right? There's kinds of other employment related issues and equity related issues in other countries.
In general, we've done, because we also survey on the other side of the house investment firm compensation. So we also have the same platform and, survey process and consulting for investment firms. And we did do an analysis of Europe versus the United States, and Europe generally was less, but none of this is a hard and fast rule, because there are some areas and industries right now that are just very hot. And as you saw that Andreessen's opening up a London office or a fund to have for different currency. And I think, you just depends on where the growth is. I'm in Miami now. And of course, here it's obviously there's a premium for some of these companies and roles that might be higher than you would think from the Bay Area, which has obviously had some serious challenges. So it really just depends. I think we should wind up with severance. Questions came in and you can see, I mean, we could go on and on. We've got like hundreds of pages of data here. And I will throw out, I'm sure many of you have taken pictures and screenshots, which I'm, glad for you to have this information. But you can also see we have copyright information. So please don't post this or send it around. We really appreciate your respect for the integrity of the data and these slides. Okay, severance. So Mark, we always use the Wilson Sonsini helps us with these legalese, but it's compensation after employment has ended, and it's typically paid in a couple of different ways, lump sum or a continuing payment or a combination. And is there anything else we should add in terms of the severance information?
I would say when you think about severance, it's usually in an employment agreement. And you think about, how does the employment end? Is it termination without cause, termination with cause, or does the executive leave for what's called good reason, or have good cause to, you demote the person from CEO to very lower level employee? That would be good reason for the CEO to leave. And in those cases, that would also trigger severance. So those are kind of the three categories with cause. If you get terminated for cause, if you commit a felony or something, don't expect severance.
Right, I would hope not. Okay, so here's to whom do you offer severance? Obviously, CEO. Sometimes there's a president, and then other chiefs, SVPs, VPs. So obviously the CEO is very prevalent. And then severance can be, again, this depends on factors, the caliber of the CEO, how many times they've been a CEO, but in general, that's 7 to 12 months. There is the 4 to 6 months, and there's also the 13 to 18 months. And then we do this for every single job. We'll get into how is severance paid. And this is a combination of either lump sum, continuing payments, or both or either. And I don't know if there's anything else to add on this. It's typically, I know we asked these questions, but it's not included here. Is it typically base pay, or is it a combination of base and where the bonus would have been? Mark, you probably have the answer to that. Sorry.
We usually see it as base and not bonus, because the bonus is usually kind of paid out later. Unless you have a specific bonus arrangement where the bonus is kind of earned as you go, and you know when it'll happen.
This is part of the thing with bonus programs. I don't know, Christy, you can answer this. We see bonus programs to be a little tricky, right? Because to have a bonus program, you obviously have to be able to know what is it being measured against, how is it going to be being paid, what are the metrics, and that's typically also something that the comp committee gets involved in, right?
It's another reason to have a compensation committee, because usually you sit with the CEO and you devise this together. So you talk about what are the key milestones and inflection points that are going to happen over the course of the year. What are the corporate goals? Let's be very specific about them. And then we tailor the bonuses around the corporate goals and achievement of them. You can't even rarely have a gating item. In other words, if this particular one is not met, then it's zero. We have to do like raise capital, raise at least capital.
Yeah, you've got to have a metric to go how you're going to pay it.
You have to have a metric. And look, frankly, sometimes you don't meet all the goals, or you exceed a couple, but you don't meet others. And that's where the comp committee comes in to use their best judgment and their experience to determine, are you going to get 80% or 60%? So it's somewhat subjective. Mark, would you agree with that?
Yeah, absolutely.
And but the more thorough and specific you can be, the better. I'm going to show a couple of jobs. I find this is the staff level always gets I think minimized on these webinars, because we always tend to focus on CEO and the top roles. But these staff level jobs, especially jobs like a data scientist and figuring out your pay grades and your leveling structures, especially as pay transparency is becoming more prevalent, is extremely important. And whether you live in a state where pay transparency already exists, it's likely going to become, and it already likely exists because people always have been talking, for decades on the mix of what they're making versus other people in the company. But this data scientist, this is all industries under $50 million, and jobs like this in terms of total financing raised. You can see that the equity is obviously a very small percent, and the total cash, people need the cash to live. So these jobs tend to be more cash driven. But a job like a data scientist now, you can be working in a tech company, you can be working in a life science company, and these jobs are very competitive. And what we do is, let's see, I'm going to put in here so we do pay plans as well as part of our consulting. And once you get past the top job and you're looking by industry and total financing raised, you really don't need to be looking at total financing raised because for the director level and below, because equity is such a small piece of the compensation model, right? And so we look at engineering pay plans, senior engineering pay plans, a lead principal engineering pay plan, and the artificial intelligence, machine learning. So some of these jobs are getting hotter and hotter. You can see like the 75th percentile now for artificial intelligence and machine learning is at the highest level, right? So the 25th percentile and then the median, they're pretty close, but at the top level, you can see which jobs are coming. And I think I just point this out because, things are changing and questions, come in and people ask us all the time. And it came in here is what is happening as a result of the market? And maybe it's a good place to wind up. And really what's happening is a different use of the compensation tools. But the comp is not fast moving, right? It takes a lot of data to move a median or a 25th percentile. It's really just where companies are using this information because obviously the market and fundraising has gotten to be a little more challenging. Christy, you mentioned this in the beginning, and I'd love to hear what you're seeing with your portfolio companies in terms of their fundraising.
Well, I think generally fundraising is taking longer. No one wants to hear that, but I think it's a reality. We're seeing that with our existing portfolio companies and also with the ones that we're getting ready to fund. And it just takes a lot longer. I mean, a number of months longer than it had been before.
But people are raising money, right? And Mark, you were talking about this too. Yeah.
Yes, they are raising money. It will take longer. The main thing is getting your lead investor. And once you get the lead, everyone will follow very quickly, right? But it's getting the lead is taking a little bit longer. But I think the strong will survive and make it through this. And there's still a lot of innovation that is being funded right now.
Yeah. Mark, you're winding up thoughts on this?
Yeah, so I agree. It's taking longer. The other thing that we're seeing, companies are getting funded. The deals are taking longer. But what we're seeing is that the amount in a deal where you might get a lead investor coming in and saying, okay, here's how much is needed for the operating budget. You're not getting that full amount. And so we're kind of seeing, subsequent closings getting pushed out, looking for other investors, and they're not actually closing on it. So as a result, the implication of this is, I mentioned earlier that the equity pool is kind of planned for on the assumption that you're going to raise a certain amount, and that gets hardwired into the documents at the first close. That may not be the right size pool anymore if you don't get all the money that you expected. It may be too large of a pool, and then you kind of make up for it on your next round. But that's something we're seeing that we haven't seen in a while, is that not only are the deals themselves taking longer for that first close, but subsequent closes are either taking a lot longer or they're just not happening.
Yeah. Y'all have been great. We had a flurry of questions. I hope we addressed most of it. As you can see, the more data and information, and you use the expertise of your people like Mark, and of course, we're here to help at J.Thelander and going to firms like Hatteras. There's a lot that goes into being a successful company and being able to raise capital and to sustain these turbulent times. But It is happening, and we wish you all the best of luck. And we will send out a recording from today and a follow-up email so we can answer any questions. We'll also send you a survey link because all participants do get access to a subset of the results for no charge. And of course, in times like this, it is very important to use data. So we'd love for you to have access to a no charge part of the J.Thelander platform. So thank you all. And we will reroute again for our next webinar. Thank you. Thanks to the panelists. Bye-bye.